Hey, welcome to another Thursday afternoon. My name is Jeff Harrison, and the show is Mortgage Minute. And we talk about everything. Well, not me, but the expert, our host, Art Alvarez, talks about everything that has to do with home mortgages, strategies to help you get a loan, remodel your home. Maybe you want to have a retirement, use a reverse mortgage. He talks about all these things on this show. The coolest part about this, it is live. So I'll be over in the background. If you have questions, put them in the comments and Art will answer those. With that, I see Art is in the green room. It looks like he's done powdering his nose. He is ready to come in. Hey, Art, welcome. You look so good.
Hi, Jeff. How are you?
Great, great.
I wouldn't go
Sorry,
that.
we had a little technical back-end difficulty, but you did it without a problem.
Yep.
So,
Got through it.
busy day today in the world of mortgages.
Yeah, it is. The financial markets, of course, are acting a little against the direction we'd like to go, or going to the direction we'd not like them to go in terms of bond yields and mortgage rates. And in fact, it looks like we're about to hit a record not seen in 16 years in terms of the 10-year bond yield. So that's going to give some people some groans.
Well, it's interesting. It's like if we roll this back about 3 weeks, we were having some optimistic outlooks because things were going to be changing, and maybe it was the last of the interest rate rises and things of that nature from the Fed. And every year, as businesses do what they call a SWOT analysis: strength, weaknesses, opportunities, and threats. Well, who would have thought about putting down a middle war or a war in the Middle East as a threat that would cause some ripples in our market when it comes to financials?
Right. Well, that's the thing. That's what can happen with financial markets is some event, international event and so forth. And oftentimes those are bad. They're not good. Can really shake things up. And that's been a factor this week and actually really the last couple of weeks. But that combined with, we keep getting these pretty strong data points in terms of the economy being stronger than everyone thought. So I think that's a factor for sure.
Yeah. Well, let's get into it. I'll step away and then I'll be back. So
thanks, Jeff. Hello, everyone. Welcome to this week's Mortgage Minute. My name is Art Alvarez. I'm with Mortgage Works, where we have the answers and they're on the house. And as Jeff and I were just talking about, it's been an interesting week in the bond market. Unfortunately, not really going in the direction we'd all like to see, those of us who are looking at mortgage rates. And there, Jeff just pulled up our latest rate grid from our website. So as you can see from these rates, everything's pretty much in the sevens now. Even unfortunately, FHA, VA, we've crossed the 7% mark. So everything you see on there, other than those temporary buy downs at the top of the rate grid, are all well into the sevens. The one silver lining has to do with rates on equity loans, which I'll touch on in a minute. So what's going on in the markets this week? What's going on with the 10-year bond yield? Well, as I alluded to at the introduction here with Jeff, we're basically back to a 16-year high on the 10-year Treasury bond yield. It's right there, just under 5%. And so, unfortunately, that's further increases that we've seen just since April. I mean, earlier this year we were down below 450. So 5% looks like is right there, ready to be crossed. And in terms of mortgage pricing, mortgage rates, we have had some more increases, but in a relative sense, not as bad as I would have expected. So a little bit of optimism there on my part. So what's driving the yields this week? Well, there's really just a couple of things. This week, the primary data points: retail sales, housing starts, and existing home sales, and initial claims for unemployment, which of course is a weekly data point. This week, what really shot the bond yields up was the retail sales number. It was considered super hot. Came in at 0.7% increase. 0.3 was forecast, so that's considered more than 2.5 times higher than expected. Although what's interesting is there was an increase expected, and this just went over that by a little bit. So even though the number that came out was close to expected, because it was so strong compared to the month of before in August, that really drove bond yields up. The consumer is definitely spending money, continues to be doing so, even though there's some other data points that would signal weakness. So that really shook up the markets this week and continues to do so. Housing starts also was a factor. They were up plus 7% after being down 1.5% in August. And actually today, the initial claims for unemployment actually dropped below 200,000. That's a sign of a strengthening economy, less people filing claims for unemployment. So that hasn't helped either. I think that's part of why we're up close to 5%, as well as Chairman Powell, chairman of the Fed, today gave a speech noon Eastern time, about 9 o'clock this morning, my time. And he continued to talk about how the economy is going along pretty strongly, while they have, at least for now, indicating they're going to pause on another Fed funds increase. He's definitely saying there's more on the table, definitely saying inflation's too high, and certainly saying that we should expect, as it says at the bottom of this slide, expect rates to stay higher for longer. And I think underscoring his comments, understand that the markets right now are going to be extremely sensitive, extremely jittery as it relates to any data points that come out that signal the economy strengthening. So we get any more data points going into next week, the week after, that are strong on the upside in terms of the economy roaring along, that's not going to help us with bond yields. So that's your mortgage rate and bond market update. I want to go now to something I've kind of noticed here in the last couple of weeks, really. And it's a situation that I find very odd in terms of how borrowers in the U.S. are behaving. And in that sense, what I'm seeing is, as I put on the title of this slide, the U.S. consumer seems to have a bit of a split personality. And I'm referring to that as it relates to mortgage debt, credit card debt. So what do I mean by that? Why is there this split personality with the U.S. consumer? Well, to start with, as you all know, we've talked about it a lot on this program, and you've probably heard it in many other news sources, et cetera, your friends even, and relatives and coworkers who are in the real estate markets. The real estate markets are locked up. Mortgage rates have more than doubled in the last couple of years. Inventories continue to be tight because there's a lack of sellers putting their homes on the market. So this is helping to prop up home values. Home values have not dropped as significantly as everyone expected. That's in part, probably in fact, mostly due to the very tight inventory. And because the rates are high for mortgages, buyers are hesitant due to the high rates and the high home prices. You put those two numbers together, and many buyers are saying, even if they can qualify for these higher payments at these higher rate levels and higher home prices, they're not willing to step in and undertake that. Why? Because they're waiting, thinking that home prices are going to fall or interest rates are going to fall. So that's the real estate market. That's what's going on. That's the behavior that is resulting from these higher rates. Now look at consumer lending. It's really different. Consumer lending, you may have heard, is exploding. Credit card debt, well, let me back up. Credit card rates, just to compare to mortgage rates, credit card rates have more than, they haven't more than doubled, but they've been up over 50% in less than 2 years. The average credit card interest rate is 21%. Several years ago, it was 14%. So quite a big increase in the average credit card interest rate. And yet, despite this very high increase in credit card rates, what's happening with credit card debt? Is that market locked up? Is borrowing credit card, money on a credit card, is that dropping because of high rates? On the contrary, it's exploding. Credit card debt is now over $1 trillion. That's an all-time record. So how can it be that when credit card rates have risen very dramatically, maybe not quite as much as mortgages, but certainly very dramatically, even despite that, credit card borrowing is going very strongly, and mortgage borrowing is very anemic? Doesn't seem to make much sense, does it? And by the way, on that credit card borrowing side of things, understand that there's virtually no federal cap on credit card interest rates. Believe it or not, there are some cards out there where the interest rate is as high as 36%. So that is about the most expensive borrowing you can imagine. So with this disparity in how rates affect the mortgage and lending market, what's going on? Why is this happening? And of course, I put on the slide here something that I will say from time to time. Only in America will a couple go out tonight and put $200 on for a nice dinner on a credit card at a 21% interest rate, and then during that dinner complain. I actually use a different word than that. That's a little too salty to use on this program. So they'll put $200 on a 21% credit card and during dinner complain about a 7.25% mortgage rate. It doesn't really make much sense when you think about it. Now, of course, I know that that couple says they're going to pay that account off at the end of the month because they always do. Well, folks, I've seen enough credit reports to know, even after being told that by some borrowers, the credit report tells a different story. So I've been there, seen that, and I understand that's not always going to happen like the borrower says it's going to. So where does equity lending fit into all this? If you're a homeowner, you're in that real estate lockup mode. You have a 2.5-3% mortgage. You want to sell, maybe because you need another bedroom. You've had another child delivered. You want to add in a pool. You want to maybe put in a outdoor kitchen area. There's all kinds of things you might want to do to your house, but you'd rather just go buy another house with all those features. But you got a 2.5-3% mortgage. That's giving you pause to put your home in the market because you don't want to undertake today's rates at 7.25%, 7.5%, and so forth. So where can equity lending play into that? Well, certainly in terms of providing you the funds to do those improvements. But more importantly, let's look at the credit card debt. Again, it's exploding. And so what that suggests is that even some of you homeowners that own a home, you have a lot of equity, you have a very low first mortgage rate, I should say. And yet you may have some credit card debt that's creeping up there. Maybe it's $25,000, $30,000, $40,000, $50,000. Yes, folks, I've seen $60,000, $75,000, even $80,000 in credit card debt. That's an issue, and equity lending can play a factor in helping you with that. With credit card interest rates up 50% in just a couple of years, it is not advantageous in any way, shape, or form to continue holding that debt, particularly if you're a homeowner with equity. And if you have a low rate mortgage on your first mortgage, you don't want to touch that. Understand, equity lending can play a role in helping you get your debt situation realigned, retargeted to get your interest rate cost down. So that's again a second very big reason people use HELOCs or a fixed rate second called a HELOAN to borrow against your equity to pay down that credit card debt. Now remember, if the average credit card debt's 21%, HELOCs, depending on your credit score and your loan to value, how much equity you have, you can get those as low as in the low 9s to probably about 10.99, 11%. So that's sort of the sweet spot right now for HELOCs. Call it 9 to 11. Well, if you've got credit card debt at 21%, it will make sense to consider that HELOC as a way to consolidate all that credit card debt into the HELOC and cut your interest rate nearly in half. Plus the fact you're adding the additional element of the potential for tax deductibility of the interest by moving that debt from unsecured credit cards to the equity in your home. So financially, all else being equal, it's a great financial strategy to pursue to lighten the burden of that very heavy interest rate debt, that very heavy interest rate burden with credit cards. I mean, my word, over 21%. That's crazy. However, in saying that, I want to urge that if you're a homeowner, you're on the fence about doing that, it's a very good thing to do, but you've got to really have a talk with yourself about changing behavior. As Dave Ramsey, as I mentioned in our program last week, I actually agreed with him that now's a good time to buy, but you got to kind of reorient things. You've got to really work on eliminating, he says, pay it all off. I'm not going to go that far, but you really got to reduce your unsecured consumer lending, credit card debt, personal loan debt as much as you can. That's very high rate. You need to get that down and eventually get it paid off. A HELOC can get you on that path to do so. However, understand that you're using your home equity to pay off short-term debt. Short-term debt, as the label would suggest, is something that can occur. It's something that, unfortunately, some borrowers will tend to reincur that debt more than once. And that's dangerous. What you don't want to do is get into the revolving door of running up your credit cards, which basically means you've decided to spend money you don't have readily in your checking account, thinking you're going to pay it off later. But then, of course, you have trouble doing that. Next thing you know, it's growing. A HELOC can help stop that process. by transferring that debt to your equity and paying that debt off at a very, much lower rate. Again, potentially almost nearly half half lower rate or 50% lower rate than what you have now. However, what you don't want to do is complete that transaction and then keep using those credit cards. You got to put them away. You got to realize when you're spending money, if it's not in your checking account, have a talk with yourself. Try not to make that expenditure unless you know you've got the money to do it without putting it on a card at 21% interest. So we can help with that. We can help you provide the vehicle, the HELOC, the equity loan, to consolidate that credit card debt, get that interest rate cost way down. But we're going to do that while also trying to help you, counsel you, give you some advice, even maybe direct you to a third party credit card, not credit card company, but a nonprofit company that provides education and assistance in not only raising credit scores, but managing credit and doing so in a much more responsible way. So we can even help you with that. So just realize we're a resource for you. We can help you get out of this exploding credit card debt situation. But in doing so, we're going to kind of help you, kind of counsel you on how to do that and make some permanent changes in your financial family budget so that you're better suited in the long run for whatever options that are going to be available to you. So Jeff, I want to go ahead and bring it back into you so that we can talk about this week's, I guess we've got a question or two we want to discuss specifically.
Yeah. First of all, I think that's some powerful information about the whole, as I'm listening, I'm thinking, geez, 21% is probably a low interest rate on a credit card. And, based on the balances, it could be higher. So you're more than cutting that in half, aren't you? Your actual interest rates you're paying. And then what about the payback period? A typical credit card, how long is that payback period, Art? I'm not expecting you to be an expert at that, but just curious.
Well, it's extremely long. In fact, most credit card statements now, I think, are required by regulation to kind of give the consumer some indication what the payback period is, depending on what payment amount they choose. And normally those statements are going to say if your minimum payment is, $35, it will tell you if you keep making that payment, how long it's going to take. And it's almost like the term of a mortgage.
Wow.
Which of course you can argue kind of humorous way. Well, it's going to take you almost as long as a 30-year mortgage to pay it back anyway. Well, why don't you move it to your house, cut the interest rate expense in half, actually net cutting a little bit further because of the tax deductibility possibility. Check with your tax advisor. I'm not an accountant. So you can reduce it by more than half, but you've got to then do some behavioral changes, put those credit cards away, don't reuse them, or at least not reuse them in a significant way, and you're going to be well set going forward. So that's the way you've got to think about it. And the other thing, and I'm going to touch on this on another, maybe next week's program or another segment, credit card borrowing is a major, takes a major hit to your mortgage borrowing power. People don't realize if you have $25,000 or $50,000 of credit card debt at these interest rates, you're basically preventing yourself from getting an extra $70,000 to $140,000 in mortgage amount. So if you're looking to buy a home, you don't own a home now. If you've got $50,000 of credit card debt, you're really impacting your ability to qualify for that higher mortgage amount because of just the interest cost on that level of credit card debt. Again, we'll cover that in another segment soon, but it's the numbers are really kind of breathtaking.
Wow, that's amazing.
Yeah.
Well, as I hear you talk about the numbers and retail spending and really our economy is being driven by those credit cards, it sounds like. But at the same time, I keep hearing people talk about, tightening their budget and being consciously aware of, well, I'm not going out to eat dinner as often. And, I'm not doing this, I'm not doing that. In other words, they're being more fee conscious. And with that, I want to talk about, the fees and the transparency of the fees. And I'm just curious, when it comes to the question about fee transparency, how can home buyers ensure transparency and fee disclosure when working with someone like you as a loan broker? And what should they look out for in the fine print?
Yeah, that's a very good question, and you're right in terms of we hear all this news stories about how the consumer is sensitive to fees and going out to dinners too much, groceries cost too much, et cetera. So one of the things that's always struck me about the mortgage industry is how the cost of the product, it's really a service, but we'll call it a product for now. The cost of the mortgage product, when you're going to borrow, get a mortgage to buy a home. What's interesting about our industry is there's really, in my opinion, not enough focus on upfront asking what the price is. What's the price going to be for this mortgage that I'm applying for? Now, of course, price itself is a term that I'll have to get into in yet another segment. I always like to refer to mortgages as being priced, or when you're getting a mortgage, what's the price of your mortgage? Because that can involve not just the interest rate, but potentially origination fees or points if those are involved. But what's interesting is in the mortgage industry, most borrowers, I don't think, delve into upfront before you've even applied for the loan. What's the price of the mortgage that I need for this scenario? So I would start there, is that when you first encounter a loan originator where you're maybe shopping for a mortgage, maybe you're going to talk to a couple of different companies, and you've got a particular transaction in mind. Maybe you're about to make an offer on a property, so you know the price, you know what your loan amount is going to be based on what your down payment is. You're going to probably have a general idea what your credit score is. Well, guess what? With just that information, and if you know which kind of loan program you want, any loan originator can give you the price. And what I mean by the price is they can give you what the interest rate available should be from them, and what the closing costs are. They can do that through a worksheet, a closing cost worksheet. That's an acceptable format for providing this kind of information to a borrower. It's got the proper disclaimers to indicate it's not a loan estimate, which is the official document that you'll get later on in the process. But what's interesting is it's readily available, and most borrowers getting a mortgage, I would argue, probably have no idea what it is and never get a chance to see that even before deciding to sign an application with a particular loan originator they're asking for information from. So I would start there, is you've got to ask for what the price of the mortgage is going to be based on your situation. Again, your down payment, your purchase price, what you think your credit score is, and what kind of loan do you want. A conventional 30-year loan, 15-year loan, you want an FHA. Any originator can give you specific numbers for that loan based on those parameters. And along with that, if you're successful in getting that worksheet, you don't get pushback, which I'll mention what that's all about in a second. If you're able to get that worksheet, when you get it, I would urge you should ask the originator, and again, this will work best if you're dealing with a broker. With these terms, what's your lender paid compensation? I think a borrower is entitled to ask the originator that question. So when you get a worksheet, what is your lender paid compensation going to be based on these terms? That way, you're going to get a good idea how those terms presented to you were, decided upon, because they're going to reflect what the originator is going to get paid for delivering that loan, what the broker is going to get paid for delivering that loan to one of their lenders. So I think that's a question you should ask. So really, there's two questions. When you're checking with a lender or originator, particularly if it's a broker, ask for a closing cost worksheet up front, even before applying for the loan. If you get it, then ask, what lender paid comp is this worksheet based on? And that'll give you all the information you need to know to make an informed decision as to, is that the best place to get your loan? Now, I mentioned earlier about how if you don't get pushback, many originators are going to push back on that and say, no, I can't give you any hard numbers. I can't give you a written estimate. It's on the loan estimate, which is an official regulatory form that is triggered within 3 days after your application. So a lot of originators will say, no, I can't give you any kind of written numbers. I can give you a verbal. I can kind of tell you where the market's at. Can't give you any written numbers until you apply for the loan, sign your application, we get your file registered, and then within 3 business days, you're going to get a loan estimate dispersed by the lender. And at that point, you'll know what the terms are. Don't go for that. You don't have to wait that long. You can get written numbers up front, even without applying for the loan. So I really, really urge people to do that. Now, and again, that's all part of the process of you're buying a product. You should ask for what the price is up front before you sign anything. So then the second thing is when you do go through all that process, you get your loan registered with the lender, you're going to get an initial disclosure package within that 3 days. As I mentioned, it's going to include the loan estimate. Within that package are going to be other disclosures that will also let you know as the borrower what that originator is getting paid by the lender for delivering that loan to that lender. It's on different forms, like the mortgage broker, the loan estimate may have mortgage broker fee right on it. That's one place to look. More in California, we have the California DRE disclosure. Right on that form is going to be the disclosure of what that originator is getting paid by that lender for getting that loan and funding it for you. So in those disclosures, when you first get them, you'll be urged to just go through them quickly and DocuSign them. That's fine, but you do want to glance through some of those. And in those disclosures, you're going to get additional information that will tell you exactly what the originator is getting paid for arranging that loan and delivering it to the lender. Again, information I think you should know as early in the process as possible. And that's much more easy to get if you are dealing with a broker versus a commercial bank, mortgage bank, or even a credit union. And remember, as data now shows, homeowners on average, or borrowers or home buyers on average, are going to save about $9,400 in getting their mortgage over other types of lenders like the banks, the credit unions, or the mortgage banks. So, Jeff, there you go. Back to you.
Yeah, just a couple of little follow-up questions on that. One is, what is the average home loan being originated now in the state of California?
Oh, in terms of well, the median price in California is about $600,000. In fact, I just read, this is another interesting sort of cross current of data points. I just read the other day, a couple of days ago, down payments are increasing. The average down payment now is 14%. So you do the math on that, median price of 600, average down payment of 14%. Median loan amount in California is, of course, it depends on what county. Riverside County is lower than, say, LA County or Orange County, but it's going to be somewhere in the $500,000 range. So, in that respect, how much the originator gets paid is directly tied to the loan amount, because typically their lender paid comp is a percentage of the loan amount. So those who want or demand a higher lender paid comp from the lender, they could end up getting paid double the amount of dollars, let's say, than somebody like we would for that same loan amount, even though the work involves the same.
Well, I'm just curious. So if that average loan amount, let's say their down payment is $500,000, what is the average broker fee based on your knowledge? What's the average broker fee that you're aware of that someone like you gets paid?
Well, yeah, as we commented on last week's show, I had mentioned that I've been told by multiple account executives of the wholesale lenders I do business with that most of their brokers get a lender paid comp somewhere between 1.75 and 2.25% of the loan amount. Well, do that math. That's like for a $500,000 loan, you're talking, $8,000 to probably $12,000. So, with us, we've been at 1.25. So for us, a $500,000 loan amount currently would be about $6,250, 1.25% of the loan amount. So we're already lower, I think, than most of the brokers we compete with, and we're working on a plan to maybe sharpen our pencil, if you will, and maybe just go to a flat 1% of the loan amount, which I think is definitely going to give us a unique position in terms of what we can offer to borrowers as it relates to interest rates, which is very important now as rates continue to rise. So all we can do to keep those rates down to the borrower, we're going to try to do that.
So just playing Columbo here, for those of you that remember him, is so what you're saying is, if I got a loan from somebody down the hall and it's 2% and it's $500,000, that's $10,000. Where does that $10,000 go, and who pays it?
The $10,000 in a majority of cases, the $10,000 in your example would be paid by the lender who funds the loan to the broker who initiated the application with the borrower. So again, the lender does pay the broker in a majority of transactions, not the borrower. Now, when I say not the borrower, let me clarify that by saying not the borrower directly. Because as I pointed out, I think in last week's episode, if we end up going to 1% on our lender paid comp for that $500,000 loan, the lender is going to pay us $5,000. If the broker down the hall, his lender paid comp with the same lender is 2%, then that broker is going to get $10,000 for that same loan to the same lender with the same borrower. Now, let's add one other element to your scenario. The borrower insists on a 0-point rate to them. So how does that get accounted for in these two different lender paid comp schemes? Well, the way it spits out in rate is the rate I can offer at 0 points is going to be lower than the rate offered by the broker down the hall who wants 2% for the loan, not 1%. So as a consequence, and what does that mean in terms of rate? Well, a 1% difference of the loan amount is going to be roughly equal to probably at least a quarter in rate. So at our compensation, 1 point, 0 points to the borrower, we're probably going to be able to offer 7.25. This broker down the hall who wants 2% from the same lender for the same borrower for the same loan, he or she is going to have to offer 7.5 in order for it to be 0 points to the borrower. So as a consequence, you, the borrower, should know what the lender is paying your originator for that loan, so that you now know how your rate's affected by that. And in this example, going with that broker who wants 2%, not 1%, you're going to pay a 0.25% higher rate on your loan than if you came to us.
So you're really, now, if I'm that borrower, I'm paying for your compensation throughout the life of my loan
through the rate.
Lender, through the rate.
Through the rate. Yep.
Wow.
Yep.
All right. Well, once again, this is where you want to be if you want to know anything about mortgages and strategies. And really kind of, in this case today, we kind of did pull the curtain back and said, hey, what are you wearing back there? And let's find out about it. So I really appreciate that. Art,
Sure.
with that, I'm going to turn back over to you and let you finish up today's show.
Okay. Thanks, Jeff. Okay, everyone. I want to go into last week's closing question. And it was one that I recently got actually 2 weekends ago from a past client who was listing their home for sale, and they have a VA loan on their house now. Can a non-veteran home buyer assume an existing VA loan in a home purchase? Again, can a non-veteran home buyer assume an existing VA loan in a home purchase? Great question. There's lots of 2.25, 2.5, 2.75 VA loans out there. I've made a lot of them here in our local market, and there's a lot of those in many markets. Well, the short answer is yes. Yes, a non-veteran home buyer, that's somebody who's never been in the armed forces, can assume an existing VA loan on a home purchase. Now, a couple things about that. Typically, you've got to qualify, what we call credit qualifying. That doesn't just mean you've got to have a good credit score. You're going to be essentially put through the same process as you would getting a brand new loan. Submit an application, provide income documentation, asset documentation like bank statements, etc. They're going to pull your credit, evaluate your credit score. All that's going to be taken into account. They're going to calculate your debt ratio. So essentially, you're qualifying for the loan just like you're getting a brand new loan. So that's number one. Now, if it happens to be that you as the buyer who wants to assume the loan, if you are a veteran also, then you can actually assume that loan through credit qualifying and have your entitlement for the VA home loan benefit replace the entitlement that was used by the existing owner of the home who got the existing VA loan. So a new veteran borrower can assume that loan and use their VA entitlement to replace the current owner, the current borrower's VA entitlement. So that's something to keep in mind. But there are some implications to the veteran borrower who owns that current home with that existing mortgage being assumed. A couple things you need to know. One is, when that loan's assumed by a non-veteran buyer or borrower, your entitlement that was used when you, the seller of the home, got that existing VA loan, that entitlement is still tied up, if you will, until that loan is paid off by that new non-veteran buyer who assumed the loan. That can be important because sometimes a veteran will own a home, have gotten a VA loan, and the VA loan amount they needed to complete the purchase of their existing home didn't use up all their entitlement. they may have had some remaining entitlement left that would allow them to buy another home with a VA loan. They wouldn't be able to get a zero down loan, at least not one at a very large loan amount, but they could get one with a pretty small loan amount by using a partial entitlement. So just understand that if you sell your home to a non-veteran buyer, and if you do have partial entitlement, that's all you're going to have access to until your existing VA loan is paid off. And if your existing VA loan used up all your entitlement, then you can't use your VA home loan benefit again until that existing loan that non-veteran assumed has been fully paid off. And then one other watch out for is if at a later date your non-veteran borrower assumed your VA loan when you sold your house to them, so they've assumed the loan. If at a later period, a few years later, they go into default, they don't make the payments, the lender has to qualify. That foreclosure of the existing VA loan that buyer assumed from you will wipe out your entitlement for good. You will not be able to get another VA loan in the future. So just keep that in mind. If you're a homeowner, a veteran homeowner with a existing VA loan, you're thinking about selling your home and offering your existing VA loan to be assumed, just be aware of these couple of implications to do that, just so you're fully informed. Okay, and with that, we'll go ahead and go into next week's closing question. Again, this is a question I just got a couple of days ago on a new purchase loan that we've started. And the question is, after executing a rate lock agreement, if the market improves, can the borrower get the lower rate? Common question, and there's a pretty standard process to address this in the mortgage industry. So tune in next week, and I'll have the answer to this question, and it will be on the house. Thanks. Jeff, back to you.
Art, once again, another great program, and really looking insight into what's going on in the market with the retail sales up, credit card debt at an all-time high, and the options that you're presenting. I want to ask a question. A few weeks ago, we talked about that 5-minute mortgage and 5-day funding. Is that still available?
It is. Again, it's one of basically three equity loan options that we have. We have 3 different lenders we use for equity loans. So we have the ability to offer HELOCs as well as fixed rate seconds. That includes investment property, rental property. And that also includes, yes, the fully automated, 5-minute HELOC, or 5 minutes to get that initial approval, but they can be closed in as quickly as 5 days. So we have all those options. And one of the things I always try to stress to folks too, if you're a homeowner, you've got the equity, you are still on the fence about a HELOC, part of why you may be is HELOCs, equity lending, can be pretty tough on borrowers in terms of qualifying based on credit score. Many of the major banks and so forth, if you're not at 700, 720, you're going to have a hard time getting a HELOC. Some will go to 680. But we've got some options for folks who are a homeowner, got the equity, they want to tap into it. If they're between 620, 680, we've got some options for them, either on a HELOC or a fixed rate second. They should not be bashful. They should call me. I can certainly give them some numbers so that they can tap into that equity, because they may have been told no more than once.
Well, here's the information for Art on the screen. Of course, it's Mortgage Works. His name is Art Alvarez. 760-883-5700 is his office. And of course, his cell phone, no matter what country he's in, whatever he is swimming in, he has that cell phone handy. 714-612-9035. You can always check out the website. As you saw at the very beginning of the show, that is a rate grid that is constantly being updated, as well as all those other features below with calculators and all kinds of other things that you can use to help make some decisions if for some reason you want to do that ahead of time before you get a hold of Art. And of course, you can always email Art at art@mwloan.com. Art, again, thank you so much for being here again today. And we appreciate the feedback and look forward to seeing you again next week. With that, I am out.
Okay, thanks, Jeff. Thanks, everyone. Thanks for watching and listening. Again, my name is Art Alvarez with Mortgage Works, where we do have the answers. They're on the house. So take care. We'll see you again next week. Thank you. Bye-bye.